What up, everybody? Good morning. Welcome to the show. Everybody, looks like tomorrow, CPI day. Tomorrow's gonna be a pretty big day. Core PPI on Wednesday. I think we got some PAL stuff coming through. It's gonna be a pretty busy news week. Michigan number coming out Friday. This is gonna be a huge busy, and of course, monthly expiration. This is gonna be a week that moves. That's for sure. Welcome everyone to the show.
Hi, it's Will from Google.
I'm marking up in minutes. Tablet here set up. No signal.
What if I told you there was a way to potentially hedge against inflation?
What up, everybody? Okay. All right. Pre-market. Those DD bands on my Thinkorswim. They're not correct. Because we rolled into a new contract, they're actually going to be off center by a little bit. So let me go to ES. For today, so let's do them like this. Let's go directly to the contract. Now they're correct. Simple as that. Looks like we're opening pretty middle of the range. Flat, flat, flat. VIX has been trading down. We also have some VIX yellow lines that are here. So obviously VIX has been crashing through some key areas. Not sure these guys came from. This is very old. I'm just keeping these as a history. So remember, we got a pretty busy week, pretty busy news week. We can hit some volatility. This is a key support level on VIX futures. These yellow lines can create pivots. Obviously, we've been pushing. Just be careful that we don't have anything. You know, hedge pressure breaks can just completely destroy the market if it happens. I'm not gonna be doom and gloom. I'm not gonna be doom and gloom. I'm looking for, you know, the market to tell me what is. I'll trade long if we get long. So perfectly rational. Like I changed all my contracts to U23, so you can actually see the continuous Friday to today. Now the DD bands are correct. So we're opening middle of the range. Things are good. A little dripped up in SPY. Getting ready to roll. I'm on a space. So hold on a second. You're ready to get going here. Give me 1 second, you guys. All right, market's open, scared to go. Welcome to the stream, everybody. It's time doing a million things at once. So we have opened. So this is a whole resilience play right now. Anytime you open outside of the box, monitor resilience. Resilience, nice and steady. Anything that's bullish, opening above the box support to DD band is where we're looking to go. If we get anything, so that 43.57 to 43.80, it's about 2 points above. So it's gonna be about 4.33, give or take. Okay, so keep an eye on this. If resilience stays positive, we're gonna support a half gap that is a long entry for the open. That's a good one for me to take. Okay, so as soon as the liquidity maps come through, see, we get a nice little play here. Anything's coming through, yeah. QQQ is opening gap up as well. Resiliences are good. Where's the data? Come on. All right, everybody, good morning. And we're back. Second. Futures market not yet operational. They're working on it now. Oh, 1 second. Looks like I have a 0 data point, but maybe hoping they'll have a data outage today. Good morning, everybody. Looks like our data's not coming through. Hang tight. I'm getting the check on this. See zeros right here? Looks like the API did. We got the data people on the horn. They're checking. All right, we're gonna have to wait. All right, nothing's coming. So these are zeros, meaning we don't have any HPs, MHPs, nothing. So hang tight, you guys. So we'll go with what we have so far, right? Let's take a look at just what we have. Let me just reboot everything. So it looks like the API hiccuped for a hot moment there. Okay, so let's talk about resilience first and foremost. Let me get my pen right here. Draw on the screen. What a morning already. Okay, no trade yet. Nothing good yet. Okay, so when you're outside of the box, res type 2, when res is bullish, which we have all rational signals so far, no hedge breaks yet, but as soon as we get the data come through, we'll see that. So res greater than 0, if we support the box, it's going to DD ban. Okay, that's trade number 1. That's the resilience video. Number 2, support here if res is greater than 0 as well. And it looks like res is kind of similar on the fence. So res greater than 0, it's a support. Res less than 0, it's a gap fill, right? So we have to watch this one. So far, so good. So far, so good. It's going to want to support. So today, since we're inside of the box, I'm going to want a long off of here. Maybe add a little bit more to it from there. And then, of course, I'll stop on the other side. I'll have to see where the hedge pressures and everything are at. But don't forget to smash that like button, everybody. It's your first day here. Welcome to the stream. This is how it is. Kind of doing a quickie little tutorial. In the morning, just taking a quick look at everything. For whatever reason, we have a data outage today, so they're running it. So we're gonna get some manual pulls in just a second, but I'll have an update for you just as soon as I can. Okay, so right now I'm looking for half gap to support. I'm gonna take a look there. Let's get QQQ, same thing. And the resiliences are looking a little weak for being as high up in the box as we are. So, I mean, stocks are going to sell pretty hard today if it does fall. So be very careful that today is not that day. I'm not going to rush into any long today. VIX has been trading a little bit higher in the last hour or two. So I'll take it. I'm going to say that my call today is probably not going to be a solid up day. With resilience already popping 2-0, being at half gap, SPY is going to try to fight here, but I'm not going to take the long anymore. A little bit of index divergence between the two. This is the bad index divergence. You're going to have SPY being negative and NASDAQ being positive. When they're that far apart, that's actually irrational. This light's about to turn red in just a second. So as soon as they stretch more than one's minus 10, one's greater than 10. So now you're going to have a lot of a difference between the two. Is it right on Thinkorswim? What do you mean it's not right? For you? Yeah, contract roll. So the way to do it is that on the day that you roll over, go ahead and type in the full contract code. Don't just look at the continuous contract. In Q, type in U23. And that way you have Friday's close on the September and Monday's open on the September. Right? And then you do it like that. I'll give it to you. These are in the DD calculations once again. They should be right. Let me double check. Good. Sorry about. They are correct. They are correct. It's just for a new. Yeah, the ones in the bot, they're correct. So take a look at this. Looks like we have a little bit of downside with Russell today. So I think that today, honestly, I'm glad it's trying to data outage. Today's not really much of a confidence in this anyway, so I'd hate to be fighting a loss. I think that, for at least for right now, Res going negative, we're going to be filling gaps to the downside today, and leading the way, NASDAQ is, S&P and Russell pulling back. This is probably just going to be a sell-off day, which is good. So get a lower low for tomorrow. We're going to have obviously some volatility coming tomorrow as well. Check QQQ. I probably made a mistake on one of them. Let me look. 14.57. What's the bot say? 14.627. Oh. 14.858. Yeah, they're right. They're all right. I already checked them. Yeah, they're correct. Okay. So, so far, I'm not liking what I see. So today is down. Sorry, but I don't have any data to show you guys. For First 8 Rocket Scooter, this is going to be a kind of a fun experience. Have a little bit of a data outage today. I'll have a report for you just a second. So this is a key indication right here. Resilience being less than 0. Look over here off to the side as well. I'll teach you guys a little bit about resilience. So resilience is a gap fill predictor, right? And so when it's bullish, what it does, it shows what stocks are doing in their redistribution zones. So you can actually divide up the box into little sections like this. Just like that. And if anytime you're inside of the box, the state of resilience being just barely positive, it's going to want to support half gap, like I said earlier today. If it's negative, it's going to want to fill the gap. So as you see, it got negative for a little bit, tried to fill the gap, jumped right back up to positive, and then it didn't. So if you look at this, this is showing that very, very, very tight little spot here. So anytime you're outside of this box and resilience is greater than 0, it's going to want to trade higher to the next resistance. So let's kind of put that up here. And I do little slashes like this to show breaking through. If you are trading outside of the box, like a gap and go, then that's what you look for as well. And then your first place to look is your what we call first resistance. So currently on our first resistance, we have those DD bands, right? And then you're going to look for anything else that's in the way, like a gap fill, or just basically anything that can show you that this is going to bump into something. You analyze it in each of these sections. So this is a trade area, trade area, trade area, and trade area. So currently right here, DD is not that strong. It's barely positive. It's just barely positive, right? Being right on the edge, I don't like to take that gap and go trade. If this is like 20 or 30, I jump in and take it. So majority of stocks are kind of just playing in the middle, right? They're not really gapping and going. So I think that the index is going to have any big run off of this. The upside, I don't think so. You need to see the stocks moving. Oh yeah, my trading platform open. Shit. As soon as the data comes through. So you can see that it's trying to fight its way lower, that positive swing up. It's probably likely to fill the gap to the downside today if I were to take a guess. If this resilience is pressing lower and you have divergence there, S&P typically wins the show. So even without liquidity maps coming through, obviously we're down for the moment. We don't know what DD or any of that stuff is. We're trying to get the data pushed through. Itai, I told you, you have to roll your contracts over. It's a new contract month, so, or a new contract reference point. So in futures, there's different contracts, right? Okay, so here's how you do it. You guys have to so I'll challenge you. Do me a favor. Understand how the futures market works. Right? We have some classes on this stuff, so I'll teach you here. Whenever your platform switches your contract, your platform has nothing to do with me or Rocket Scooter or anything. Your platform decides to show you a different contract. If I type in ES right here, right? This is what this is what some of y'all are noticing. Let me give you a quickie crash course in futures. This isn't a me thing, this is a you thing. I can't control what you see on your thing. There is no official rollover day, right? There's no rule for this. Everyone's different, okay? So if you have a different experience, and this happens every month, I know, so I always love to have the same speech for the new folks. Okay. You wake up, you see this, and you go, well, wait, hold on. My DD indicator's wrong because my trading platform is now showing something like this. And what is going on here? Let's give you a quickie. Wait, we're outside of the DD bands? Absolutely not. Okay. Some of you might be seeing this today in Thinkorswim. Thinkorswim has decided to now take, if I type in NQ into here, just FYI, /NQ is not a product to trade. This is not even a thing. This is an equation that chains two actual things together and decides to show one here and another one here. It's actually NQ, right, is just a ticker. And then you have little letter codes that go after it for month and year. That's exactly, yeah, I know you guys are seeing this. I'm reading y'all's minds. I have the same speech every 6 times a year. Trust me. So your platform decides to show you September now instead of the contract it was showing you, and you see this. Your platform has rolled over the contract. This contract has been trading, though, the September one for a very long time. You're just seeing it now, and now you need to adjust. Anytime you see this, what you got to do is you got to go all the way over here. And just for this one day, because really this is showing you what you've been staring at for a while, and now you have a new contract here. You want to see what this contract also looked like on Friday. So while Fridays, pretend that if they're both trading, like this one also looks like this. Like this one looks like that. It's just down here. This one looks like that as well. So your platform, when you type /NQ, is like daisy chaining these two together. Does this make sense? You see, this contract effectively, these CD bands are referencing that contract because it's looking at the close of Friday. Yours is showing a new one that's trading up here. So the close price in your equation or whatever you're doing is off. You need to be referencing this one with bands that are utilizing this close price, which you're not if you're just using NQ, for instance. So the way that it works, to get over this hurdle, in your platform will roll this every whenever. Now, traders have a rule of thumb. You typically roll into the new contract and start trading the new one when the volume has moved to the new one. You put the two side by side. And when the volume for the new contract outpaces the volume of the old one, then traders typically roll. But that's like a rule from like the 90s, okay? That's not really a modern rule. Oh. So in reality, in the long time ago, futures contracts weren't so liquid like they are now, right? You typically didn't want to trade an illiquid contract. Think about trading an illiquid option. There's just no volume. And so you get bad fills and like nobody's really trading it. But in the electronic markets, they're all super liquid. You can roll whenever you want. So a good rule of thumb for the modern trader is just roll when your platform rolls you. There's a downside to not rolling fast enough. Last period's contract is still just as liquid as the current one, even if the volume's higher. Typically, you don't want to go like 3 or 4 or 5 months out. But for your index products, they're so liquid, it doesn't matter when you roll. So you don't have to think about it if your platform moves you here. Oh, okay, well, time to roll. Your trading view or trade evade or anything typically will roll you as well. They usually have a rule of thumb. They'll roll sometime around when the contract ceases trading. There's, they all somewhat do it differently. So just remember, there's no standard rule of when you will see this. All the platforms can do it differently. As a trader, as you see last week, people were asking, Matt, when are you going to roll the contract? When are you going to roll the contract? Right? Everybody does it different days. So today you're experiencing it here. Others experience it elsewhere. But in reality, that is the adopted rule of thumb, is that whenever the volumes move to the next one, you just compare the daily volumes of the U23 versus whatever the last one was, June, I guess. So that's it. And you put them side by side, and the higher volume is the one that wins. So to do the fix, just go here and just actually look at the contract itself, not the continuous one, just the actual September 23rd contract. And watch what happens when I zoom out. You can see that this contract doesn't exist forever, right? This contract only started trading in January. Actually, no, not January. It's gonna be 2 years ago. You see that? 2022. Well, the first time this contract ever had a print would have been right here. Actually, a year ago. You see that? You see how illiquid it is? Like nobody really trades it a year ago because it's a year out. Y'all see that? Actually, no, it should be more than a year. Hold on. Go all the way back. It should be right here. I guess that's as far back as it goes, yeah. So the last day, the first print of this one was September of 1 year, yeah, 2022. My bad. So that's what happens is this contract is trading and other contracts are trading and other S&P contracts are trading. They're all trading at different values, but the shape's relatively going to be the same. You see how like when you're a year out, it's not really that liquid, but about 3 or 4 months out, it's still pretty liquid. Oh, liquidity maps just popped up. There you go. So you can see how it's not really a big deal, right? You can see it's not really that illiquid would mean you would have much trading. So here's the answer. Go right here. And just type in U23 and look at that. Your DD bands are fixed. Just for today. Just for today, just look at this contract because what your equations are doing are referencing the Friday close price. And so you want to make sure you're looking at the Friday close price of U23. Louis says open interest. Yeah, everyone has, there's tons of ways, you know, traders do it. I always like to roll my futures contracts around a monthly expiration. That's the best time to do it. Like like for instance with the VIX, I roll the VIX contract over the Tuesday before the third Wednesday when VIX options expire. So I like to roll the contract when it's relative to the overall experience of what's going on with that thing. An example being, you know, VIX, our triple B reference comes on that Tuesday. So that's when I roll VIX over. I don't care what anyone else's rule of thumb is. With index futures, I just do it whenever I think Thinkorswim does. I don't really have, to me, I do it because I'm presenting to you guys. So I don't do it with my own system. I do it when this rolls so that everybody's, for the most part, on the same page. So you can look at the open interest. You can look at all kinds of stuff. All right. So if you guys just type in U23 at the end of all of your contracts, you're good. Easy as that. U23, U23, U23. And then that's just for today. And then today we'll close at U23 and tomorrow we'll open at U23, which means at 6 o'clock tonight, you can go back to looking at regular NASDAQ. Just hit /NQ. So if I just do that, you'll see that, oh, it's gapped, right? And the DD bands are off. So you'll, every time the contracts roll over, and how do you know this? Well, most platforms will give you a little designator here or some kind of detail. For instance, here, NASDAQ will give you a vertical green dashed line. You see that? Oh, you should, oh, there's a gap here. Did it gap up? No, no, that green dashed line lets you know that we rolled into NASDAQ U23. And then there's probably a rule somewhere in Thinkorswim where you can tell it when to show that or not to show that, like on the display. So if you turn it on to show that, then you've got that there for yourself to remind you, oh, that's the rollover. The trick is I take exactly what I see here and type it in the box right here. /NQU23. My head is turned sideways. I'm looking at that little green line there. That was a long speech just to tell you Thinkorswim gives you the answer, which is kind of neat, right? They give you a little reminder for you in Thinkorswim. Cool, cool. Okay. And that's just for today. So remember, tomorrow you can get rid of the letters or leave them there. Appropriately so. This is the actual instrument you're trading, U23, and it has a history that only started last year, right? It doesn't have, 100 years of S&P data behind it because that /NQ is what's called a continuous contract. So it's a fake hypothetical instrument that chains every front month together. Currently, this is the front month, the one you're trading. So while this is the front month, that NQ is going to possess this contract's data. When we roll into the next one, then NQ will possess that one's data. So it's like chaining all the front months together. Okay. Hold on one second. I got to talk in the space. Okay, let's get our liquidity maps front and center. Okay. All right, so let's go ahead and take a look. All right, mean reversions short up. Let's go ahead and pull up the liquidity map. Let me show you what we're looking at here. So any of the mean reversions are going to balance between bull and bear walls. And letting you guys know, we actually have a new liquidity map graphic we're working on. Let me just show you something real quick. I'll give you a little fun detail. We're playing with one that's actually going to match better with the platform look and feel. This is just a draft. We're still working on it. Tell me if you guys give me a little vote really quick. So right now the market's neither bullish nor bearish. We're going to take it very easy today. Do y'all like this? This is the old one, right? This is when we had walls, and now we've just clustered the walls into zones, right? Hold on. The S&P came in. It's basically like what we call mean reversion or liquidity pocket. It's not really bullish, not really bearish. It is kind of a flat-ish day. Obviously, with the CPIs and PPIs coming out, you know, we have a humongous week. Michigan numbers on Friday, I think, and monthly expiration, and VIX expiration as well. This is gonna be probably like one of the craziest weeks we've seen. So I'm not really trusting a lot. And the S&P is not coming in very bullish, which is expected. There's going to be probably a relaxation day. The resilience numbers are showing that the gap up is still strong. It's going to maintain its halfway point. We call it the half gap. That's good, but we're opening below hedge pressure. That's not so great. So that basically doesn't mean that the market's going to sell off. It just means that it doesn't have a lot of upward steam. I'm not jumping in on a very strong long today. Nasdaq has mostly exhausted itself, I think, as of just this morning. Monthly maps are still very bullish through the middle of the summer. So you guys know that Rocket Scooter can forecast and look for these pivot points months out. Last October, we were tweeting about this is the bottom for a while when everybody thought we were crazy. And every single day we're looking months out, and it's showing that there is still bullish positioning and bullish risk on the table out in the future. So right now the S&P is still strongly bullish, at least through the end of July. You can see that, and the bear side is still getting squeezed until the end of July. I'm showing this on my screen right now. So in the general sense, this market is not done going up. The Nasdaq as well. It's the same thing. So why are we squeezing up? There's genuine buyers and shorts are getting out. It's very expensive to keep shorting this market. And if the Fed's going to relax on their rate hikes, clearly, Wall Street doesn't have any bear momentum or mechanism to really drag the market down, straight down from here. So I still think the summer is going to be really bullish, and we might just hit, our next bear stride at the next quarterlies. So everything's good right now. Nothing looks bad. Today just might not be a huge rally day, but every dip is getting bought up, as you can see. Nasdaq's the only one that really, to me, kind of looks bullish. We have a 354.5 on QQQ hedge pressure, and it's opening on a bull zone as well. So we're getting a little bit of support there. I would say that I just mark stops at 354.5. If we lose that, it could be a sell-off day. And then Russell is probably the one that's been looking great for a while. And 185, you have monthly and weekly hedge pressures there. Those are going to be really strong pivots. You can see, we calculate these numbers at the start of the day, and Russell has bounced very hard off of 185 as well. It's continuing to move higher. So you are seeing just a little bit of sector rotating before monthly expiration. It's pretty normal. Obviously today, Russell's moving the highest, Nasdaq's trading down, and S&P's being moderate. So basically, as long as people are putting their money somewhere, the markets typically don't sell off and crash. So like today, why I don't feel an up day, I'm definitely not shorting it. As you see, the appetite of Wall Street is to go long in small caps or smaller caps. Clearly, they're just rotating money into one. So it's not going to really crash anything else, I don't think. So if there is a little bit of a down day, it's probably going to be mild. And that's it, because VIX is so low. The market's liquid enough to hold it. So that's what I got. Medium to bullish. That's all I have.
Decently bullish on your end. At least for a little bit here, so I'm continuing to keep my eyes on the market. Watch it potential push upwards. Looking at SPY right here. Not giving me a whole lot of direction on this 15 minute. Fortunately, we're just sitting right on VWAP. One thing to pay attention to is HYG credit.
Yeah, on HYG, and there's a 74.5 as a key monthly hedge pressure level. on the HYG. So for those of you not listening, that's a great. I love they brought that up. It's a great tool. Whenever you're looking at market integrity, people tend to risk out of riskier things first. So like the Russell being small cap stocks, HYG is an ETF representing high yield debt. So that's obviously people will get out of that pretty much quickly. So stocks tend to follow. If that's collapsing, it just shows a near-term appetite for bearishness. So great thought. 74.5 key level there today. So we were talking about high yield debt. Okay, let's go to monthly map. Which one do you want to look for? SPY or QQQ? Okay, so you kind of have to be like, okay. So what you do is you draw a line. We do it for you, but in these 0 days, there is no line because there is no space between those boxes. You see this in general? Okay, so the first thing you do is when you connect all these boxes, you tell yourself, Wisdom King, here's an example. Is this trending down or trending up? Easiest way to do it. We'll give you a quick and dirty tutorial. You look at the bottom of the bull zone and you say, which way is it trending? Up or down? Is my mic muted? What I drew. Don't let green fool you. Is this red line trending down or trending up? Clearly trending down. Clearly, extremely down. With a couple of up weeks, right? So what that means is bulls are willing to buy lower during that time. And then, generally speaking, here it kind of starts going up. There's a clear inflection point right there where you can see that behavior. Right? Between here and here, it's not necessarily trending up. It's like flattening out, right? So trending down and maybe trending up and flattening out. So there's a clear inflection point right here as the sentiment shifts from one way to the next, right? You'll see that? So essentially what it is, if you were to think that like right here, let me zoom in and make it easier for you to read. So you just think the opposite. If the bottom of the bull zone is trending lower, then it means bulls are getting stronger or there's more bulls. The bull side is getting stronger. You do the same exercise. So always just think the opposite when you draw these two lines. I can explain it further after the demonstration, but clearly the bear side, you just match the top of the box line, same direction, right? The bull zone was kind of like this. Bull side trending down, bear side trending down. So not only does it mean bulls are getting stronger, so there's more bulls. The bear side's getting weaker, there are fewer bears. And what does that mean? A bull is somebody that is entering a long position. A bear is somebody entering a short position. So more bulls means more longs. Less bulls means less shorts, meaning that the people that were short are actually covering, which means the bears are converted to be buyers. They're forced to buy. They have to cover. And the bulls are buying to get into a long position. So what happens is you have more bulls longing the market and bears that were short exiting the market and going to cash. So bears are converting to cash through covering, bulls are converting to buyers by longing. And the two of them together is a double dose of buyer. Short squeeze and longs going together, which sounds weird, but the market has been trending up since October with this same pattern. Shorts are squeezing and people can't long the market fast enough. That's exactly what you see day after day after day after day. It's both, boss. It's a short squeeze and longs. Longs want to buy this, which is pushing the market up, which is causing shorts to squeeze. And every dip that comes by, people are wanting to long, which again are squeezing shorts out. So the actual buyers are squeezing the shorts. It's a traditional mechanic for market reversal. So the reason why it goes opposite of what you think of it like this, right? Let me just give you a blank space to draw on. This is fun to look at, okay? Imagine price is right here, and your monthly map has bull zones here. We're gonna call these bull zones, and we're gonna do bear zone, pick a different color. Let's use a little goldenrod color. Or actually more of a yellow color, okay. Let me actually do prices green. And this is why it does this, right? Okay, and these are key levels over the next, this is 1, 2, 3 weeks out. So say that the price right here falls, not bearish, not bullish for today, and holds. As you see, bull and bear. If today we crash, and this is what the map looks like. This is today, next week, next week. So if price crashes today in the middle, it's not bullish, it's not bearish. Do we agree? Yeah, so Wisdom King, you think of it like this. If you have a double dose of buying, it's clearly a bull market. If you have a double dose of selling, it's clearly a sell-off market, right? If they're competing against each other, or it's neither bearish nor bullish, then you can't really make a good assessment. It's probably liquid and balanced. Okay, so in this particular example, it's not bullish nor bearish here, but tell me about what this price looks like. So say that you fell, and it's definitely not bullish this week. But if I were to draw a line and just imagine if price stayed exactly here for 2 more weeks, tell me what price is like next week if it stays exactly here. We crashed today and it doesn't move anywhere for a week. It's not bullish this week, but now it's a new week. What is it here? Bullish, bearish? It's bullish the following 2 weeks. And even so, it could fall even lower and still be bullish, and fall even lower and still be bullish, right? So the idea that it can fall lower and lower and still be bullish means that as time passes by, it's more bullish at a set price. So when the bull side gets lower lows on monthly map, it means there's more bulls waiting to buy, or more calls that are in the money. There are no calls in the money for this week. There are no calls here. But there are calls that are in the money here. So the people that sold those calls, the people that sold these calls that are in the money, are forced to long that thing because those calls are in the money. So because there's more bulls underneath you as time goes by, there's more people that sold those calls that are forced to long the market. Think of it like that. There's a million ways to wrap your head around it. A lot of people just think of it like this. If you had prices flat, it's how much space you have below as the weeks go by, and more space means more bulls. Just think of it like that. More space is more bulls. Calls expire, they need to buy. There you go. Not just the calls, but the call seller, right? If you bought the call and they're in the money, you may or may not buy. You have the option. But the call seller, every single time, will have bought, because they need to hold that position such that in case you exercise your option, they can sell you the stock. So if you don't exercise, they just dump it to the market, but they don't want to have to buy way up here and not have a position on the table. They're going to long at a rate of delta per options contract. Everyone like the stream? Oh, thank you. So the idea comes down to this one fact, is that if I sold a call and you bought a call, okay, let's call him market maker M and trader C. You bought the call, so you may or may not buy 100 shares at any point in time when those calls are in the money. Okay. You have an option, right? And in the United States, there are American style options, and American style options can be exercised at any point in time. European options are different. European options can only be exercised on the day they expire. And just as a side note, if you trade futures options, by the way, American futures options, which is like S&P futures actually has an options contract. You can trade S&P futures options. They actually are European style. You can only exercise those on the day they expire. So American stock options, you can exercise them at any point in time. So say this is your strike price and price is trading through here. Okay. You bought a call here, market maker sold a call to you, and price is way down here, your call's out of the money. Market maker's like, yeah, free theta. Trader's like, oh, damn, my calls aren't making me money. Shit. As the price moves up and it goes in the money, you're making profit. This market maker is now, they're sweating it out. They're like, ugh. That's supposed to be like a not pleased face. They don't know if you want 100 shares or you're going to cash out for stock. So they need to have the shares in their pocket in case you go, I need to exercise them now. They can give them to you. The later they wait to buy those shares, the bigger their loss is in that trade to you. So trust me when I say anyone that sells calls that's a market maker does not sit there empty short against you. They will hedge those calls they sold neutral every time. As price moves up, as you know, there's a phenomenon called delta, right? Delta is the amount of price change of the options contract versus the price change of the underlying. But delta is also what they hedge. So if delta goes from like 0.2 to 0.3 to 0.4, every 0.1 delta, the market maker is going to go buy 10 shares and 10 shares and 10 shares until delta's 100. They're going to buy 100. They're perfectly neutralizing that trade as that call goes in the money. So as you get right at the money, 0.5, 0.6, that delta change is very rapid. That change in gamma forces them to buy, and then of course they're forced to buy along the way. Now either the market maker has 0 shares, and the minute they go in the money, they just buy 100 to neutralize the whole thing, or they long at a rate of delta, which means they long really hard at the money. Either way, they're longing as price is going up just so they can stay neutral in case you exercise. Long story short, if the calls are in the money, you're forcing some call seller to long the market. And as it goes up, you're forcing them to long even harder. So not only do you have bulls willing to be long, you have people that sold calls that are like, shit, I have to long. Yeah. And that's why that works. And so when we map out the market maker risk like this, thank you, mine as well, appreciate you. This is just, we wanted to see something that can forecast how far in the future that risk changes. And as you see right here, while it is generally bullish through here, it's not necessarily bullish there anymore. It actually becomes bearish around September at the same price. So you see between July and September, this 380 level in SPY definitively switches from bullish to bearish. Exactly where my mouse is. This is key to note. What's bullish here, is possibly bearish there. Which basically means if you look at it in the opposite sense, right? SPY's still willing to trade up, right? Looks like this week we still have bullish SPY. And then some profit taking. As you get the bull side gets weaker, well, there's some profit taking through here. And then SPY is going to trickle up some more probably. And then some profit taking. And SPY is going to triple up some more. And then probably trade down. So how high does it go? How low does it go? Who knows? But I'm kind of saying we got maybe 1, 2, 3 waves up. So this market's going to trade up and consolidate for about a month and a half. Easy to see that. And that's just the bull side. And the bear side, even so, as you see, every bear is getting squeezed so hard. The shape of this is just nasty. So for the next couple of weeks, not only do you have 3 bullish waves of SPY, give or take, you almost have 2 solid weeks of bears getting squeezed. So what that means is, think of yourself on both sides. If you're a bull, you're waiting for every dip to find. And of course, the reason I'm showing these nice gentle waves is because VIX is collapsing. So there is no volatility. So volatility would mean there's no liquidity, no bulls or bears. But you can clearly see there's more bulls stepping in the picture while bears are stepping away. Slightly illiquid, but still very liquid because there's buyers. Right? So as VIX is collapsing, there's not going to be a big dip. Also, you see bears can find any excuse to get out. So any red day we have in the S&P, imagine yourself being a bear that's like, oh, thank God, my loss is less. Let me get out of my short. So every dip that buys, not only is it not volatile, but you got a bear willing to cover a short. So now you're painting a picture. This is like a consolidating pennant wedge, call it whatever you want. Every dip is going to get bought, and they're going to be small and smaller and smaller and smaller as VIX is small. Number two is every big dip you have on an event, the very next day, the market's going to snap back up, at least what the bears are telling me they're ready to get out at a moment's notice. Can y'all see all that? So the fact is that you have this gentle sloping on the bull side and this rapid deterioration on the bear side. Which means if the market was flat, the bulls are adding a little bit of pressure to the long side. And every single red day we get on like in a catalyst, right? Big red day sells off, sells off, sells off. It's not the bears winning, trust me. It's like the bears that have been feeling heat for the last 4 months are like, oh, thank God. Whew. And the next day it will snap right back up. So every big sell-off day is likely to be met with another green day. Pretty cool, right? This same pattern has been there since October of last year. When people said we were crazy, when I said, hey, I have this new tool called monthly maps. And let me tell you something even cool about monthly maps. I don't have Ashton's here. Back in October, Ash and I were just chit-chatting, not even thinking about partnering up. I told Ashton, I was like, hey, dude, because I was like, I know you're an options seller. I got this thing I made. I want to show it to you. Because Ash and I were buddies. We used to be on a podcast on with The Street, which is a big media publication. So Ash and I, we met on the podcast, chit-chatting. I was like, hey, you sell options, right? I was like, check out this thing I invented. He's like, what is it? I showed him. He's like, oh, yeah. He's like, I heard about that thing. You guys, that rocket security thing. How's it going over there? I was like, oh, yeah, it's great. Let me show you something. And I whipped this up and showed him what it was. And he looked at this thing and like, he's like, wait, show that to me again. And I showed him what I just showed you guys. And like, there was like a moment of silence where he just sat there and he was like, you know what you've made, right? And I was like, yeah. And he's like, we talked like in December and I was like, yeah, you see that tweet I made in October where I called the bottom? This is how I did it. And he's like, show me again, basically. And he's like, I want in on this. And he's like, do you know what you can do with this thing? I was like, well, kind of. That's when we made it. And then it's like a great story, right? The idea that it's still showing a bull market from two angles. It's such an interesting tool. And the bears of the world on this day, if you go look at my tweet on October 17th, this last day here, I said this is the bottom. Literally said this is the bottom. Not off of anything else other than the map. The map was clearly showing the bear side deteriorating this week. And in the commitment of traders in that very same week, from another angle, you can see in S&P futures, the dealers were net positive. So from about here, you can see that the market was trying to bottom out. Markets don't crash and dealers are net positive. And right here, you can see that, you had bull side strengthening. You see, you had basically, this is S&P futures, different angle. Longs getting more long futures and dealers are holding the bag. When the dealers are long and they're willing buyers, the market doesn't sell out. So you had two data points when you had an increase from 1 week to the next. Does everybody see where my mouse is? Right here. On the 17th, the very next week, I got the confirmation. This number, this green number in the bottom left. You see right here, it goes from negative, 180. Sorry, this one right here. That green number. You go from 180 to 223 that week. You see how this 10th, you had 180,000 long, and you had 223,000 long. That's almost a 25% increase in the long position for week over week. When I saw that green number go up, I called the bottom. Asset managers are more long the market, and monthly maps supported it. Those two things together, I call the bottom here. When everybody said I was dumb, and I said, well, this is me unveiling my new trick. I know I'm right. There are buyers when the dealers are positive, markets don't crash. And my monthly maps is forecasting. It's bullish through the year, and I tweeted that. It's not bullish for the year. I said, this is the bottom, probably till summer of next year. Because as far out as we looked, there was no pivot in the bull side. And it just went up and up and up and up and up. And here, it's still showing that it's going to go up and up and up and up and up. Same thing. Same thing. And every wave down, the bears are like, it's going to be bearish. And every wave down, I'm smiling. It's up and up and up and up. And as Matt says, Matty B nailed it. You can see volatility. Volatility starts to come in right towards the fall. The space between bull and bear zone is showing volatility. Not so volatile this week, but leading up into monthly expiration, you'll see some volatility building up. And then leading up into FOMC, there's volatility. And leading up into quarter three, very volatile, right? Quarter three earnings are going to probably shit the bed. And that's something you need to understand. So monthly maps are a little fun to look at. Let's take a look at something else. We can do stocks as well. Look at QQQ. What do you see about QQQ that's a little different than the S&P? Let's draw it out. Bull side, very strong. With no inflection point until the middle of September. The inflection point on the S&P was here. Tech is even more bullish. And isn't that what we're experiencing right now? The Nasdaq is soaring while the S&P is just mildly rallying. The appetite for bullishness is very strong in the Nasdaq, much stronger than the S&P. Mind blown again? I hope so. This shows you the relative strength of the two. Nasdaq has no inflection point until September. The S&P started pivoting right here. And the bear side is getting weaker and weaker and weaker. And just barely starts to turn up. Short squeeze in tech stock. Tech is carrying this rally. Tech will be the carrying of this rally. Isn't that crazy? Okay. Let's pick a tech stock. Microsoft. Look at the bears getting squeezed in Microsoft. Look how rapidly those bears are getting squeezed. But the bulls as well. Also getting out of the way. So when you see them fan out like this, bull side getting weaker, bear side getting weaker, volatility is going up in tech, and you're consolidating. So when volatility goes up and you're consolidating, that's a megaphone, right? Look at this. Like you have a nice tight pattern, and then you have a wider pattern. Tight, wider. It's forecasting that. It literally shows you what to expect. A volatile consolidation. Isn't that cool? Volatility. Not so volatile. Not less volatile. More volatile. Bro, I was putting together a report yesterday, Matt. I had to do this thing. I saw your invite, but I was solo queuing to kill time. I wasn't playing serious. It was my Halo buddy. Okay. So do you guys see how that works? All right. So let's look at a Tesla, for instance, right? Let's find some strength. Let's see what is strong. Tesla, so strong, right? Bull side getting stronger, bear side getting slightly weaker. So Tesla, as you see, straight run parabolic curve as both sides are buying. Fun, right? Meta. Ooh. All right. Tell me about Meta, guys. You guys do Meta real quick. And I got something I got to do. Tell me what you think. All right, you guys. Sorry about that. I'm back. Had a quickie little meeting here. All right, what'd you say about Meta? Let's go. Meta actually looks like bulls are stepping aside from Meta, and bears are getting stronger. Meta's peaking. This is what this tells me. Right? Volatility is tightening up. So Meta is going to consolidate and peak out. And bears are going to be building a bear position. And from this week to the next, bulls are likely to step out. So it does look like that we will likely consolidate, and then eventually Meta is probably not going to break highs and likely sell off. At least according to this. And you have to wake up every morning and redo your maps. So you can see that some stocks don't look so hot, right? So Keith, the monthly maps update every single morning with the new data, and they change whenever they change. Some people might be willing to hold through short-term good or bad news. Some people may not. So the way that you look at it is that you may see drastic changes, you may not. You have to just kind of look at each one of them one at a time. So as you see, Google is very similar, but not as bad, right? For the first week. And then Google again gets volatile and weird. So you have bulls stepping away, bears getting stronger. So bulls weakening, bears weakening. So tech is peaking ish for a little bit, for a week or two. So leading into expiration, I'm more inclined to think that we don't break out to new highs this week. And then you get volatile leading up into FOMC. I think there's FOMC somewhere in here. Right. So generally, tech is still strong on the long haul, but you have like a down week and then another up week. But then bears are starting to build a position again, right? I'm sorry, bears are starting to get out of a position. So bears strengthening, then immediately getting out of the way. Bulls weakening and then getting strong. So again, we're likely to fill out this gap next week or two, but not really. Sorry, I'm so tongue-tied here. We're likely to, I would say, not fill this gap, but likely to test it. And even if we do fill, I would say that we're still supporting in there, you know, through the summer. So pretty violent down week or two is possible, but then let me start over. Let's go here. Sorry, you guys. This is just another something like that. There you go. So let's look at some finances. See the financials good. JP Morgan gapped up. Look at this. Massive short squeeze in financials. And also bulls getting out of the way as well. So volatility is increasing on both sides. So again, that's that kind of like expanding volatile kind of pattern, right? Lower lows, higher highs. You can even see it right here, right? Bulls getting out of the way, bears getting out of the way. Bears getting out of the way faster, the slope is more, so short squeeze is likely more possible than basically like bulls buying. So likely another move like that. Yeah, PNC, like you can look at some of the, let's see if there's a really bad looking one. You see what some of the worst ones look like, right? Bulls holding, bears weakening. So again, likely short squeeze persists there. Last before I get out of here, Disney. We're looking at that after Disney gapped down. We're still analyzing that. Bulls are strengthening, bears are weakening. So Disney looks like it's gonna. Now, remember 2 weeks ago, Disney was not showing signs of life. Now Disney's finally starting to show a little bit signs of life. Short squeeze finally comes out 2 weeks from now. See how that works? It's a pretty cool technique. I'm glad you guys are hanging in for us to check that out and share that with you guys. Let's get one final read on the SPY before I get out of here. I got a lot of work to do today. Appreciate you tuning in. We're going to do an educational session in 1 hour, so make sure you don't miss that out. Miss that. Resilience, way low. I mean, resilience is just garbage today. I do think that we do likely get some selling pressure as resilience has been deteriorating all day with no irrational signs in a mean reversion, right? It's random from the middle, but that res is pretty booty from here. So we'll see. We'll see where we get. Okay. Thanks for tuning in, guys. Love you all to death, and we'll see you later. I'm going to bounce. Mean reversion, market's random from middle. DD is still 0.80, which means you have that push to touch. Right, the bull side, but the chances of breaking hedge pressure with no news and the chances of staying in the bull side when we open in mean reversion is very low. So chances are this is likely going to want to trade to here. Even if I did do anything like short, I wouldn't short for a collapse. I would get out close to here and call it a day. And that's about it. Okay, we'll see you guys later.